No, you won't become rich just by imitating the strategies of investors, but there is still something alluring about adhering to their best stock picks. After all, the investors we're about to discuss have legendary reputations for investing the money of other wealthy people. In the meanwhile, they may have a unique perspective on their stock recommendations due to their research resources and their close relationships with insiders and others. So according to their picks, which stocks are the best to buy right now or add to your watch list? Hey, welcome to Stock Market Mate. Today we'll talk about the top 5 stocks that super investors are buying. Before we get started, give us a like and subscribe to the channel to help us beat the YouTube algorithm. Everyone can learn from researching the stocks investors pursue with their money. There's a reason the rich get richer, for one thing. Yet it's also useful to recognize the short-term blunders that billionaires occasionally make. No matter how profitable they have been in the past, investors are all prone to error. Those with multi-billion-dollar personal fortunes have simply been accurate more frequently than not. Stock number 5. Disney. Walt Disney's 2023 is already off to a great start, but things for investors may even get better soon. Walt Disney is a media company with 2 divisions. International theme parks are administered by Disney Parks, Experiences, and Products. Disney Media and Entertainment Distribution manage Disney+, ESPN+, Hulu, and other direct-to-consumer streaming networks in addition to operating film studios, television product companies, and television networks. Disney also grants trademark and character rights to other parties for usage in games and goods. Since January 2022, Disney stock has decreased by nearly 45%. The entertainment company's streaming division has been losing money, and it isn't making enough money to significantly lower its debt load. Dividends and share buybacks are currently off the menu as well. Disney replaced CEO Bob Chapek after the company's September quarter earnings fell 20 cents short of consensus expectations. Chapek has made several unpopular decisions, such as raising the cost of theme parks and initially ignoring Florida's Don't Say Gay law. Bob Iger, who succeeded Chapek, is now in charge. Iger, who currently has a 2-year term, enjoyed success as Disney CEO from 2005 until 2020. There are positive developments for Disney despite leadership controversies and underwhelming financial results. Its streaming business has seen tremendous subscriber growth. In its most recent fiscal year, the corporation attracted 57 million customers. This increases the number of subscribers to 235 million, surpassing Netflix. Disney just debuted Disney Plus Basic, a lower-cost subscription service financed by ads. Expect Disney to continue increasing its streaming revenue in the upcoming quarters, but with a stronger emphasis on profitability. Disney's low stock price, improving theme park attendance, a dominance in streaming, and a reputable CEO all combine to make 2023 a favorable year to buy. Disney's consensus price target is $124.05. Currently, the stock is trading for roughly $85. Stock number 4. Microsoft Corporation. Microsoft has enjoyed a fantastic year thus far in 2023, benefiting from a broader uptrend in technology stocks. The computer giant stock has increased 15% so far this year, which is more than 3 times the gains of the S&P 500. Contrast this with how it performed in 2022, when the stock fell by more than 28%. This year's rise followed the company's stronger-than-expected financial results, which were announced on January 24. Investor confidence in Microsoft's ability to take advantage of a few sizable and expanding possibilities over the next year increased as a result of the company's resilience in the face of macroeconomic challenges. The versatility of Microsoft's company is one of its strengths, but a significant portion of its revenue still derives from the PC industry, which has been seeing a sharp drop over the past few years. Microsoft's larger personal computing business, which has historically contributed close to a third of its sales, saw a 19% year-over-year fall to $14.2 billion in the second quarter of fiscal 2023, marking the second straight quarter of year-over-year declines. Currently, Microsoft is trading at 10 times trailing sales and 31 times trailing earnings. While value investors might object to the company's valuation, we'd contend that it's a fairly fair price to pay for a business that is anticipated to grow by double digits in both revenue and earnings per share by 2024. Stock number 3. Meta. The value of Meta Platforms stock dropped by more than half in 2018, but it exploded in 2023, with shares rising by almost 51%. Even if that's nothing to scoff at, its long-term performance is just the beginning. Even with the stock's recent beating, Meta Platforms has increased by almost 375% since its launch as Facebook just over 10 years ago. The company's expansion has undoubtedly been affected by the economic downturn that started in late 2021, as Meta Platforms generates almost all of its income from the digital advertising that runs on its platform. History demonstrates that when the economy is shaky, the advertising budget is frequently among the first to be cut. With over 20% of the market, Meta Platforms is the second largest digital advertiser in the globe. Meta Platforms has been severely impacted by the downturn and the well-documented fall in ad spending. Yet there are some good news amid the storm. The digital advertising spigot will reopen as the economy stabilizes, and ad dollars will start to flow once again, boosting Meta Platforms in the process. When most experts think that a reasonable price-to-sales ratio is between 1 and 2, the stock is currently trading for 4 times the projected sales for the upcoming year. We believe Meta stock is a value at this pricing given the company's remarkable history and numerous competing growth drivers. Stock number 2. Amazon. Amazon is in recovery mode following a turbulent 2022. Even while the company's primary cloud and e-commerce businesses are facing difficulties, this doesn't invalidate its long-term premise. While the COVID-19 pandemic was at its worst and consumers were staying at home to purchase, numerous technology-related companies saw their profits skyrocket, including Amazon, whose market-leading e-commerce platform. Yet the business overgrew under former CEO Jeff Bezos, recruiting more employees and setting up a logistics infrastructure in preparation for expansion that never materialized. Customers of AWS are choosing less expensive service plans in the cloud computing space to save money in the face of rising costs and high inflation. Amazon's operating profit decreased 49% to $2.5 billion in the third quarter as a result of these challenges. Yet this is merely a speed hump, not a barricade. Amazon continues to benefit from its economies of scale and network effects, which are advantages a platform develops as more users utilize it. Stock number 1. Google. The technical ratings of the Google stock have increased despite the banking crisis and stock market turbulence. Nevertheless, Google stock has established a new foundation. Alphabet stock has dropped 40% from its record high, with the most recent decline being sparked by concerns over artificial intelligence. Given how swiftly AI has advanced, the fear of disruption is not unwarranted. Yet that might be underestimating how successful a company Google is right now, and we believe this may be a once-in-a-generation chance to purchase a fantastic company. It's difficult to overestimate how strong Alphabet's competitive advantage is around its primary search product. As the owner of Android, the business is able to set Google as the default search engine and Google Maps as the default map. The most valuable streaming company today is probably YouTube, not to mention the fact that the moats around the main search businesses are Gmail, Chrome, and the Google Play Store. Given the threat posed by AI, it's simple to claim that Google is less strong than it has ever been, and that conclusion is probably accurate. Yet, any disruptive forces that are headed for Google and Alphabet will have to get over the company's defensive walls and outwit any potential backlash Google may already be planning. That's a significant obstacle for any company. The market's concern that Google may face disruption has created a buying opportunity for Alphabet that we have never seen before. When taking into consideration the $114 billion in cash on the balance sheet, the corporation is only valued at 19.6 times free cash flow on the open market. Getting the stock for a price this cheap seals the deal. Well, that's about it for today's video. Let us know your thoughts in the comment section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!